All right. Welcome, everybody, to Climate and Business Management Week here on Crop Hour. My name is Amanda Bachman. I'm the Urban Entomology Field Specialist for SDSU Extension based in Pierre. I'm also one of the SARE state co-coordinators, that's Sustainable Ag Research and Education. And I am here with Dr. Sarah Sellars, who is an assistant professor and SDSU Extension Sustainable Farm and Food Systems Specialist. And Dr. Sellers is going to cover the Farm Bill update and implications for 2025 management decisions. Just a note that we do have CCA credits at the end of this talk. So if you stick around through the whole live show, there will be a QR code at the end for you to scan. If you have any questions during the presentation, feel free to throw those in the Q&A. It's easier for us to keep track of them there than in the chat. If you're having technical difficulties at any time, you can raise your hand or drop a note in the chat, and Candy or myself will try to help you out while Dr. Sellers is presenting. So with that, I will turn it over to Dr. Sellers.
Thank you so much, Amanda, for that introduction. And hello and good morning, everybody, from here in Brookings, where it's nice and chilly outside. All good now. So thanks for letting agricultural economist come on Crop Hour. It's really a privilege to be here and exciting to be talking to all of you about Farm Bill update and implications for 2025 management decisions. There's been a lot going on lately in the policy space. It's been pretty hard to keep up with it all, but I've been trying, and I've updated everything with the latest information for you. So I'm here to present and answer your questions. So feel free to jump in. I like to keep it very casual, so jump in at any time in chat or shout them out at me with your questions. And that's the most fun part of presenting for me, is hearing what people are curious about, what people want to know, and answering questions. So feel free to jump in at any time. I like to start with this slide. This is where I grew up, family farm in West Central Illinois. So I like to use this in my presentations. It just reminds me why I do what I do, and helps me think about kind of how all of this is tied together, and how policy affects the family farm at the individual level. So today I'm going to do a brief ag economic outlook, just so you can get a feel for what things are like in the current ag economy. I'm going to go over a policy update and outlook. So I'm going to talk about the Farm Bill. I'm going to talk about what funding has been frozen and kind of what we could see happen with that. And then I'm going to talk about the implications for management decisions this year, what we've seen in South Dakota, and what we could see, especially with the potential tariffs on some fertilizers. So spoiler alert, I'll just go ahead and give you I like to start with the main takeaways from the whole presentation. So you can sleep through the rest of the presentation if you want. But my main takeaways from this presentation are that, so net farm income is projected to be down this year. It's going to be due to low commodity prices and higher input costs. So we've seen commodity prices come down quite a bit. We're going to go over some of that. But at the same time, we've also seen input costs coming up, so that's putting a squeeze on margins, and we've seen softening of some farmers' financial positions. However, projected government payments are expected to kind of bridge this gap between revenue and expenses, and at least bring a lot of budgets into the positive according to the projections. And these economic assistance payments are supposed to go to farmers by March 20th, 2025. So you might have heard a little bit about this economic assistance and disaster aid that got passed at the end of the year. We're going to dive more into that and kind of talk about what's been going on with that. But farmers should expect to see that by March 20th. So with the Farm Bill and some other conservation funding, we've seen some of that frozen. And with the Farm Bill, we've been waiting on a new Farm Bill for a couple of years. So we're going to go over that timeline and what we should expect for this year, whether we will get a Farm Bill or not this year. I can't answer that. I've been optimistic the past 2 years that we would, but we haven't got one through yet. So maybe this year will be the year. And another one of my main takeaways is that tariffs could affect increased nitrogen and potash prices. So I think that will be important to take into consideration when making management decisions for this year and the upcoming future. So let's start with the ag economic outlook. These are the prices received by corn and soybeans per month. This is published by the USDA National Agricultural Statistics Service. So we can see that we had kind of a peak in commodity prices around 2022, 2023. And since the end of 2023, commodity prices have come down quite a bit. Still not back to where they were through 2016 to 2020, but still low compared to this previous periods. We've seen the same thing happen with soybeans. So corn and soybeans, we've seen this downward trend in commodity prices. And I'll go on, of course, I can't forget wheat. So we've also seen the same trend in wheat too, with commodity prices coming down close to historical 2016 to 2020 levels. So not only have we seen softening commodity prices, recently, these commodity prices are projected to continue into the future. So every month, the World Agricultural Supply and Demand estimates are released on the USDA website. So these are price projections for the upcoming 2024-2025 year. So these are the most recent projections released from February. Corn is projected to be at $4.35. Soybeans are projected to be at $10.10, and wheat is projected to be at $5.55. So we don't see any projected increase in commodity prices in the near future. And also a lot of the long-term estimates of commodity prices that I've looked at also show continuing trends in the long term of lower commodity prices. So for the near term, you should expect this trend of lower commodity prices to continue, unless there's some sort of supply or demand shock to the global commodity market. At the same time, we've seen lowered commodity prices in 2024 and 2025, beginning of 2025. We've also seen increases in input costs. So we've seen interest rates going up. Those have come down a little bit, but still historically high. This particularly affects these operating shorter term loans that farmers use to deal with their yearly expenses. We've also seen fertilizer prices increase. Here I'm showing N, P, and K are our most common inputs into corn: nitrogen, phosphorus, and potassium. So those have come down from some of the historic highs caused by some of the supply shocks that we saw in 2021 and 2022, but they're still high compared to 2019 and before levels that we saw. So we've seen commodity prices come down, input prices going up, putting a squeeze on farmer margins all across the Midwest. So then I tried to look at this specifically for South Dakota farmers. These are our SDSU Extension 2025 crop budgets. So what we try to do here is use kind of an average of what we think yields and costs are, and then look at how much the return to land is for our South Dakota farmers. Again, this is just an average. It's an estimate. It's a best guess. We don't have a lot of farm financial data for South Dakota, so it's hard to know exactly what's going on with farmers' finances, but we have this spreadsheet available online, and farmers can download this and put in their own numbers and put in their own estimates and come up with their own budget. So it's a really useful tool, especially when planning for the upcoming 2025 crop year. So we do this for different regions across South Dakota. This is for the East and Central high production region. So I used trend yield projections. I looked at what the yields have been doing across South Dakota for the last 50 years. So on average, the corn yield has been increasing by 2 bushels per acre per year, if we're thinking about a linear trend. Soybeans, spring wheat, and winter wheat have been increasing by 1 bushel per acre per year on average. Again, just fitting a linear trend to that data. So then I adjusted last year's yields based on that trend. And then I came up with an estimated selling price. So I looked at a lot of different crop projections, some more low, more conservative, some higher price projections, and I tried to pick a middle of the road price projection, not too pessimistic, not too optimistic, of where I think price could be in the upcoming year. If we multiply that price times yield, we get crop revenue. per acre. It's important to note that government payments and crop insurance payments are not incorporated into this budget. So other crop income per acre is a place where farmers can enter that information if they want. But again, these estimates are not including any crop insurance or commodity program payments, or again, the economics assistance payment that we talked about, some of these ad hoc programs. None of these are factored into these numbers. For direct costs per acre, I use the South Dakota State University Extension recommendations for application rates. So I come up with an estimated application rate based on the conditions. And then I multiply that by a standard fertilizer price, seed price. So those are just kind of average rates I came up with based on those guidelines, multiplied by a standard price. And then I use some estimates from FinBin. It's University of Minnesota provides all this financial data from farmers in different states. So I look at those averages and kind of come up with an estimate of what I think fuel and oil repairs, custom hire, and drying would be for some of these commodities. But ultimately, what we come up with at the bottom there is the return to land. So this is how much return the land is generating. So you would still have to make if you're cash renting this land, this would be what you would have left to pay the cash rent payment, and then you would still need something to live on off of that as well. So if we think about cash rents, particularly in this east and central high production region, that would eat up a lot of this corn return to land and push, for example, spring wheat, which is already seeing negative returns, that would push that even more negative and push some of these other commodities probably negative, such as soybeans and winter wheat. So if we look at the east and central mid production, maybe you thought my high production yields were a little bit high. Feel free, tell me what you think, what you see out there in the field. So these are this east and central mid production are less productive ground. So I put in, again, trend yield estimates based on those 2 bushel per acre corn increases and 1 bushel per acre soybean spring and winter wheat increases that we've seen over the last 50 years on average. I construct all the same financial measures. I use the same standard assumptions for prices and costs. So the difference is driven by lower yields and the different application rates we would have on these lower yielding fields. And again, we come up with the same estimate, which is the return to land. So you can see as we decrease the productivity of the land, then the return to land decreases. So again, subtracting a cash rent off of these numbers would push them negative or even more negative in the case of wheat, which is already projecting negative returns. And then as we move into the central and west low production, we see even worsening financial returns. Only one of those commodities is positive, which is corn at $8 per acre return to land. Again, we'd still have to cover our cash rent, so that would push that negative. And we see negative returns on soybeans, spring wheat, and winter wheat in this region. So not a very optimistic outlook for crop budgets in South Dakota for this 2025 crop year. If we look at the cash receipts for the U.S. farm sector, we see a similar trend. So we see a decline in cash receipts. So these are the sales of crops, animal and animal products, and then all commodities combined is the gray line. So we've seen declines in all of these forecasted for 2025. So cash receipts are down across the entire farm sector. So pretty pessimistic outlook there as well, which matches what we're seeing in South Dakota. However, the USDA is projecting an increase in net farm income from 2024 to their 2025 forecast, which you might be surprised. You're saying, okay, we have lower commodity prices, higher input prices. How are we getting this projected increase in net farm income and net cash farm income? Well, most of that is all of that is being driven by projected government payments, which are forecasted to at 42.4 billion for 2025, which is an increase from 2024, and which is driving all of that forecasted increase in net farm income in 2025 that we're seeing. So now let's get a little bit into a policy update and outlook. There's been a lot going on in this space, and I'm every morning waking up reading my AgriPulse news, trying to see what's going on, trying to get the latest information following this. So it's been an interesting time to be an agricultural economist. First, I want to talk about the American Relief Act of 2025. So as we talked about, government payments are what's driving most of that projected USDA increase in net farm income. That's driven by the American Relief Act of 2025, which was passed at the end of 2024. This is going to provide $31 billion in disaster aid and market relief. Most of that is in the form of disaster aid. So 20.78 billion is going to farmers to help with some of the disasters they saw. And then 10 billion of that is for economic assistance payments. So most of that here in South Dakota that we'll see farmers receiving is through the economic assistance payments. And those rates are shown in the table below. So for corn, farmers can expect to receive $42.51 per acre. For soybeans, they can expect to receive $29.50. And for wheat, they can expect to receive $30.69. So I've been receiving a lot of questions lately about when farmers should expect those payments. So the legislation was passed on December 20th, 2024. And as part of that legislation, the payments are mandated to go to farmers within 90 days of this enactment. So 90 days from December 20th would be March 20th, 2025. So as long as nothing is stalled, farmers should expect to receive those payments by March 20th, 2025. As with other programs, we've seen some limits on how much farmers can receive. So the payments are limited to $125,000 total if less than 75% of the farm's adjusted gross income is from ag. If the adjusted income of the farm is greater than 75% from agriculture, then that payment limit increases to $250,000. So those are the maximum amounts a farmer could receive from this economic assistance payment program. Another area we've seen a lot of funding put into agriculture is through the Inflation Reduction Act. So as part of that Inflation Reduction Act, there's a bunch of money put into conservation. There's $3.1 billion put into FSA loans for distressed borrowers. And then an additional $19.5 billion was put into funding for USDA conservation programs. I kind of break down how much is going to each program there, but the total's up to 19.5 billion. This is outside of the appropriations from the Farm Bill. So within the Farm Bill, we already have appropriations for these USDA conservation programs. So this Inflation Reduction Act provided additional spending outside of the Farm Bill that was supposed to go to these programs. Right now, it's currently frozen by the executive order unleashing American energy. This was ordered to be unfrozen on February 10th by a federal judge, but this is still getting sorted out. As far as I know, all these payments have been frozen. So some of these payments have already been made, but it's just the payments that haven't gone out yet that have been frozen. And from my understanding, they're waiting for the Secretary of Agriculture to review some of these programs, review some of this spending before they make some decisions about freezing or unfreezing these programs. And again, this is spending outside the Farm Bill. So this is separate from the appropriations that are already allocated to these conservation programs within the Farm Bill. Another program we've seen frozen is the Climate Smart Commodities Program. So you might have heard of this $3.1 billion grant program. This funded 141 different projects, and this was funded through the Commodity Credit Corporation. So it's a little confusing, but the Commodity Credit Corporation is a government-owned corporation. It's what pays all of these commodity programs such as ARC, PLC, or conservation programs, marketing assistant loans. All of that money for that comes through the Commodity Credit Corporation, which is owned by the government. So there's some legislation that says that money owned by the Commodity Credit Corporation that's not spent on these programs can be used by the Secretary of Agriculture. So we saw the previous Secretary of Agriculture use these funds to fund this climate smart commodities grant program. The idea of this grant program was to provide technical and financial assistance to help farmers implement climate smart agricultural practices. So there was a lot of discussion about quantifying the greenhouse gas emissions of agriculture, monitoring these and selling these, but there was a lot of information and infrastructure lacking to be able to do this. So the idea of this project was to collect and implement a lot of this data. And a lot of these projects involve giving payments to farmers to implement some of these practices, and then they would collect the data and come up with some estimates of the effects, with the overall idea of creating a market structure for these climate smart commodities. So here in South Dakota, specifically, we have 23 of the 141 projects, 23 projects here in our state covering 38 commodities and 95 different practices. So this is another program that's currently been frozen and it's under review. This is according to AgriPulse News. One of the projects from Iowa was reporting that the farmers hadn't received the payments, that it had been frozen and withheld. I haven't heard any updates about here in South Dakota if that's been frozen or not, but as far as I know, this program is frozen and under review. Again, from what I've read in the news, they want the Secretary of Agriculture to review all the spending before any decisions are made on releasing the funds or about the programs. So that's the latest information about some of these programs and some of the spending. Now I want to talk a little bit about the Farm Bill, what we've been seeing with that. So every 5 years, we pass a new Farm Bill or extend the Farm Bill again. So the 2018 Farm Bill was enacted in December of 2018. So we were due for a new Farm Bill in 2023. But again, we've seen this 2018 Farm Bill extended. We have not seen a new Farm Bill passed yet, so maybe 2025 will be the year. We had a couple of threats where the government was about to shut down, and also the Farm Bill, if a Farm Bill is not extended before a certain time period, for example, the new crop, the new year starting on January 1st, some of those programs within the Farm Bill revert back to the original legislative text that was written in the earlier 1900s. So if these stopgaps aren't passed, some of that legislation reverts back, some of the programs go away or can't function, so it kind of becomes a mess. But every time that's been about to happen, they've passed a stopgap measure. The most recent being September 21st, 2024, which is the American Relief Act that we talked about. It also extended the Farm Bills through September 30th, 2025. So again, we've just extended the 2018 Farm Bill again. The House and Senate have both released their versions of the Farm Bill in the last year for review. I don't know what's going to happen this year. We can talk a little bit about that because there's been some proposals to cut $230 billion over 10 years. A lot of that would probably come through the Supplemental Nutrition Assistance Program, or SNAP, formerly known as food stamps. So it's been proposed that the previous versions of the Farm Bill that have been released are going to need to be cut down. And it's going to be a fight over where those reductions come from. And also there's some new leadership on the committees, so that could change things as well. So I would expect to see updated versions released from the House and Senate of the Farm Bill, or what they think the Farm Bill should be, or where they think these budget reductions should come from. But the slim majorities in the House and Senate make a new farm bill difficult to pass. So we'll see what happens in 2025, another year of watching carefully and kind of waiting to see what happens and waiting to see some of the proposals that come out of this. So what does this mean for farmers, particularly farmers in South Dakota, when they're thinking about their management decisions for the upcoming year? So the main commodity program is called, the farmers get a choice between ARC or PLC, price loss coverage or agricultural risk coverage. So that deadline is April 15th. So then by that deadline, farmers will have to enroll in one of these programs if they so choose. And the commodities programs are they're a support program for, so crop insurance is supposed to cover the deep losses when we see times of declines in yield or revenue. ARC and PLC are supposed to cover shallow losses, so kind of on top of that coverage from crop insurance, because historically crop insurance is only insured or covered up to 85% of revenue. So the design of ARC and PLC is to cover that other, the idea is to cover that other 15% or 10% above crop insurance. Now with some of the newer crop insurance policies, we've seen up to 95% coverage offered. And with some of those newer policies, they restrict ARC and PLC enrollment and what you can and can't do, since there is some overlap in that risk coverage there. But ARC and PLC are commodity programs, again, designed to cover shallow losses. One criticism of these programs is that it takes a while. So for example, for the 2024, if there's ARC and PLC payments for 2024, we have to wait for the crop marketing year to end. So farmers wouldn't expect to see those payments until October 2025. And as we've seen in the farm budget and outlook data, farmers are facing financial challenges right now. So then we see these, for example, this economic assistance program that we talked about earlier, those kind of step in to cover these gaps between, when farmers potentially receive their ARC PLC payment, if they receive a payment, and when farmers start to actually face the farm financial crisis. So I'm just going to briefly touch on ARC PLC. I think we had a question come in. Are we going to see negative impacts in the agriculture industry in the years to come resulting from all these ARA payments going out from the government? With all the inflated projections for this year and the years following, it takes a dive due to those payments going away. How will that affect farmers in the market? So please correct me if I'm interpreting your question wrong, but so it seems to me the question is asking, how will these payments affect agriculture overall? Overall, we know that subsidizing agriculture distorts commodity markets. So that's one challenge we face when it comes to agriculture. When we apply subsidies to commodities, it causes distortions in the market, not only the commodity market, but also there's been a lot of research in agricultural economics that suggests when the land is being cash rented, that a lot of these payments are actually being passed on to the landowner through cash rent. So sometimes these programs are designed to help and provide economic assistance to farmers, but that could just be being passed on through higher cash rents. So are the programs actually doing what they intend to do? But the challenge with this is that the structure of the farm bill and some of these programs has been in place for a long time. So I think it's difficult to change that. So to answer your question, yes, payments distort markets. I think it would be difficult to transition away from this in the short term. I think we should at least be able to have this conversation for the long term, thinking about, okay, what's our best options to manage risk, farmers, it is important, this idea of risk management, crop insurance, and commodity programs, because of the dependence of agriculture on the weather. I don't know many other industries that have the type of risk that a lot of farmers are assuming. So I think it's a really challenging piece of ag policy, and it does it is distortionary, some of these payments, but I think there are some positive benefits to some of these conservation practices, and sustainable practices that are being implemented could have risk reducing benefits. So yield risk reducing benefits for the farmers. So I think more data and information is probably needed about some of that. So thank you for the question. So going back to ARC and PLC, so farmers will have a choice. The deadline is April 15th. And each year, that should say 2025 reference prices, not 2019 to 2023. So these are the reference prices that are used in the calculation of ARC and PLC payments. These are released by the USDA. These are what's been paid in ARC and PLC in South Dakota. The latest data we have is from 2023, because again, the 2024 marketing year doesn't end until August 31st, 2025. So we won't know if there'll be any ARC and PLC payments until closer to then, depending on what the prices do. But in 2023, there were no PLC payments triggered anywhere in the United States. ARC County triggered payments in some counties in South Dakota. No counties for soybeans in South Dakota received any ARC County payments. One county in the far west in South Dakota received ARC County corn payments, and then some wheat payments in east and central South Dakota for ARC County in 2023. Another thing I want to talk about is input purchases for 2025, particularly fertilizer. That's something I work with and I research, and I'm particularly interested in, is optimizing fertilizer rates and how farmers can think about that decision. Some of my recommendations are farmers to revisit their rates for the 2025 crop year, to collect multiple sources of information for recommendations, and to use your own data to think about your fertilizer decisions for the upcoming crop year, because the tariffs have potential to affect the fertilizer prices in the upcoming year and the years ahead. So if we have tariffs on particularly Mexico, Canada, and China, you should expect higher nitrogen and potash prices, mostly because these products are imported from Canada. So you could, if a 25% tariff is enacted on these products, it will be passed, not only absorbed by the seller, but also passed through to the consumer as well. So the purchaser of those products would feel the effect of that tariff. The effect on nitrogen fertilizer is less because the United States produces most of its own nitrogen fertilizer domestically. This is our nitrogen fertilizer and anhydrous ammonia imports from 2005 to 2024. So the blue bar is the rest of the world. The green bar is Mexico, the yellow bar is China, and the red bar is Canada. So you can see in 2024, we imported a little bit of nitrogen fertilizer from Canada. We imported some nitrogen fertilizer from the rest of the world. But outside of this chart, most of our nitrogen fertilizer is produced domestically. We have the facilities and plants to do that, particularly in the South, where there's large reserves of natural gas, which are the feedstock for the production of ammonia, which is then transformed into other nitrogen products like UAN or urea. The place we could really see these tariffs affect inputs are the potassium market. So it shouldn't affect phosphorus very much. Most of our imports are from Peru and Morocco of phosphorus. So the chart on the left shows the phosphorus fertilizer and phosphate rock imports from 2005 to 2024. Again, you don't see any coming from Mexico, China, or Canada, so the tariffs wouldn't affect there unless there were tariffs placed on some of these other countries where we import these fertilizers. So you shouldn't see an effect on the phosphorus market. But however, you would potentially see a large effect on the potash market. 80% of the potash imports come from Canada since 2020. So that's the chart on the right here, our potassium or K fertilizer imports from 2005 to 2024. And the red bar is Canada. So you can see most of our imports do come from Canada. The other trading partners, so that blue bar, the rest of the world, that's mostly made up from potash imports from Russia and Belarus. So those are our other major trading partners for potash. But again, if we see tariffs on products from Canada, this would affect the potash market in the United States. So kind of going off of that and thinking about how input prices, particularly fertilizer, could change in the future, I just want to briefly touch on this idea of as economists, we typically think about maximizing profit versus maximizing yield. So if we think about maximizing yield, traditionally that's been an approach thinking about maximizing corn yield, maximizing soybean yield. You see a lot of yield contests or trying to see how high we can get farmers' yields. But as economists, we also want to think about maximizing profit as well. Because one thing that's really important to think about is that maximizing yield doesn't always translate into maximizing profit. Because some of the cost with producing a higher yield can sometimes offset the additional revenue you get from the increase in yield. So it depends on the cost of the products used to increase the yield. And I think a great example of this comes from this extension article by Anthony Bly from SDSU Extension, looking at this idea of optimal nitrogen rates based on diminishing marginal returns. So we see there's a point at which the return to nitrogen is optimal. And then after that, applying nitrogen above that rate will actually cause our profits to diminish, although we could potentially be getting higher yields. So I think kind of shifting this mindset from yield maximization to profit maximization has been one of the focuses of my work and research. We can also take it a further level and start thinking about site-specific profit maximization. So farmers are generating a lot of precision ag data. Some would argue that a lot of this is not being used in the ways it could to help farmers make decisions. We can move past some of these broad-based recommendations and help farmers think about their application decisions based on their own field or by performing experiments in their own field. Because agriculture is so site-specific that we know that every part of a field actually has an optimal fertilizer rate, optimal seeding rate. So when we're providing these broad-based recommendations, we're trying to make a recommendation that fits the region or fits the best with the data we have. But we have a lot of on-farm data that farmers could be using to kind of think about optimizing their recommendations at the field level. And this is intense, it's a lot of work, but I think it's an interesting idea that we could think about and farmers could think about doing or using some of this data that they're generating from their precision equipment if they're using precision agriculture. So I'm part of this project called Data Intensive Farm Management. It's based out of the University of Illinois. It's led by David Bullock. He's an agricultural economist. So that idea is that farmers can conduct their own on-farm experiments in their own field, testing different rates, could be different seeding rates, could be different fertilizer rates, could be different products. And we could see what happens on their field and help them determine the optimal rate for each region of their field and then use their precision data to determine that and then also to apply at that rate, potentially saving them money and saving resources. So this was a trial. I'm currently involved with a couple of trials. On one field, we're testing to find the optimal soybean seeding rate. On another field, we're testing two different inputs, UAN and Pivot Bio. So we're testing two inputs at once on the field. We can do that so we can find the optimal UAN rate for the regions of that field. And then we can also find if the Pivot Bio had an effect on the yield or not. So these are the preliminary results from the soybean seeding rate trial. So we work with the farmer to implement this trial on his field. So each field is divided into different small blocks where the farmer helps determine a seeding rate. So we start with their status quo seeding rate, what they would normally seed the field, and then we determine different levels of seeding rates to test. So on this field, we tested from 90,000 to 140,000 soybean seeds per acre. So then we use his precision data to implement that trial on his field, and then we take the precision data and we analyze it and we see what happened. So when we got his data, we found that actually the highest returns would be the far left here, the rate 90,852. This is on average across the whole field. We can also look at the field because we know the elevation and we know the soil differs across the field. So we can also look at the profit based on those characteristics. So on the left, we have the elevation of the field with profit. On the right, we have the soil type and profit. So we can also help the farmer think about this and optimizing the field based on the characteristics of the field. But then overall, what this data-intensive farm management program provides farmers is one, it answers whether a uniform rate or a variable rate would be more profitable on that field. And two, it determines if the rate what their optimal rate would be. So for example, this field planting at their optimal seed rate would have increased their profits by $32.70 per acre. And then planting at the site-specific optimal rate, so varying the seeding rate, would have increased the profit by $33.91 per acre. So you can see there's not a huge profit difference applying between their optimal seeding rate and their optimal variable seeding rate. But I think it's really interesting to think about this and think about what we can do with some of that data. So we're currently enrolling farmers in this program in South Dakota and across the region for 2025. And DIFM does offer the farmers a no loss guarantee. So we know with this experimentation that farmers are assuming some risk that they could lose some money. So with that data, we're able to calculate if they lost money, and if they did, how much, and then the program compensates farmers based on that, plus some money for doing a trial as well. So I think this is one way we can start to think about optimizing seed, optimizing fertilizer, optimizing other inputs even more, especially during these kind of difficult financial times that a lot of farmers are facing. Figuring out ways to use our inputs as effectively as possible can be really beneficial. With that, I'll wrap up, open up the floor for any questions. Happy to take questions about anything or any questions you have about the upcoming year.
There was a question that made it into the chat. I'm not quite sure what spreadsheet it was referencing, but it was asking if there was a version that factors in cash rent.
Oh, no, there's not. SDSU extension does publish rental rates document though, put together by Juan Lee, our SDSU state land extension assistant professor and extension specialist, or land specialist. So I don't know if I can find the link to, there's a document that shows kind of the average cash rents for the region. So then you can kind of use that to think about what the cash rent for that region would be and then take that out of that amount if you wanted to. And if any questions come up, feel free to email me, call me. I'm happy to, if something comes up later, if you don't want to ask in the webinar, I'm happy to give me a call or email me. We can talk about it. I like to receive questions. It helps me think about what's important here in South Dakota, what challenges people are facing in agriculture here.
Yeah, and we did put your contact info into the chat, so if folks need to, they can scroll up and click on the link for your profile page on the SDSU website, or also your phone number and email address. And let's see, I think tomorrow is the climate outlook with Laura Edwards, and also a flood outlook with Kevin Lowe from NOAA. So for folks who are registered for the whole week, That's what's coming up tomorrow. And then I believe next week is Regenerative Ag Week. So we've had quite a few different themes around Crop Hour this year. I know we're getting towards the end of the series, and we appreciate everybody joining us for this endeavor. Looks like we've got a question. Are there any worries about crop insurance subsidies coming under scrutiny with the new administration?
That's a great question, and I've been thinking about this a lot. I think there's a lot that's probably going to come under scrutiny. The USDA overall is probably going to come up under scrutiny. Probably the food production in the US overall is going to come up under scrutiny by RFK Jr. Whether this will result in a policy change, I'm not sure. I'm doubtful with crop insurance that we would see a large structural change or any of that going away. But we'll see what happens. I think that it could be a topic of discussion, but I don't think they would eliminate crop insurance subsidies overall for farmers across the US. But I think we'll definitely keep seeing a lot of discussion.
All right. Well, I think we're at a good stopping point. I've noticed some folks have dropped off. We do have a survey real quick. So if you see that pop up and can take a few moments to answer those questions, we would really appreciate it. Your feedback helps us think about what topics to schedule for Crop Hour for next year. And again, if you have any questions for any of the speakers you've encountered on Crop Hour, we're all on extension.sdstate.edu. If you click on our experts, you can find all of us that way. We really love getting emails because then when we're not in the office, we can still answer you. And there will be a recording, sans the QR code. The recordings will be available on our SDSU Extension YouTube channel. There is a Crop Hour playlist. So yeah, thank you so much, everybody, for attending. Thank you, Dr. Sellars, for your presentation. And everybody stay warm out there.
Thank you all very much. I appreciate it.